Hello, everyone. This is Justin Smythe from nextbigtrade.com. This is your weekly index review for February 2nd, 2024. Starting off this week with the S&P 500, you can see that the S&P 500 gained 1.38% for the week. Volume was, again, heavier this week. And a lot of that volume came on Wednesday, where the market had a negative reaction to the FOMC. This was definitely the most action packed week for the stock market this entire year. And it was due to a number of mega cap earnings releases and an FOMC release where the Fed decided to pause cutting interest rates as of their Wednesday release. And then on Friday, the jobs report was also a major influence on the markets, and in particular on the US dollar, which we'll discuss in the sector review. So, tons of things happening this week. Overall, the market closed higher, but internally, it's important to actually study what really happened here. And starting off with Monday, the market went up a little bit, but then on Tuesday and Wednesday, the market sold off. And on Wednesday, the market again had a very negative reaction to the FOMC. The market sold off on the heaviest volume essentially all year. On the daily chart, you can see this red bar. This is the biggest daily volume since December, where the market had a major sell-off intra-week, but then was able to recover multiple weeks later. And then what happened on Thursday and Friday, and in particular on Friday, is Meta and Amazon earnings really goosed the market higher, and the market closed at new highs for this overall uptrend after those earnings. So, the market was essentially saved by these earnings releases late in the week. This is very similar to what happened actually 2 weeks ago, where SMCI came out late in the week, had a monster earnings pre-release, and that really goosed the market higher that week. And heading into those last couple of days of that week, the market was actually selling off on heavier volume until those earnings releases, or SMCI came out with its earnings. So interesting kind of dynamic here where just a few mega cap stocks, again, continue to really power this market higher. And internally, as discussed in the sector review in the newsletter, and we'll go over in the video, there's lots of internal weakness across all of these sectors. The semiconductors have multiple stocks that are starting to not act right again, home builders, and just across the board. So even though this market is making new highs, there's less stocks participating. There's not that many big winners, and there's just not a lot of trading opportunities. And that's a lot of times this is what happens towards the end of a major uptrend. So that's what's going on with the S&P 500. Jumping over to the NASDAQ 100. Again, the NASDAQ 100 did close higher for the week, but if you drop down to the daily, the NASDAQ 100 was actually down for the week heading into Friday. And again, when Meta and Amazon came out with earnings, the market went higher on volume. So those earnings releases really saved the NASDAQ 100. The NASDAQ 100 and the NASDAQ composite did underperform the S&P 500 this week. So it's the second week in a row that technology has underperformed the S&P 500. And this is interesting because large cap tech has outperformed the rest of the stock market since March of 2023, where the market came out of a bear market and went into a major uptrend. And the question now is, are we starting to get to a point potentially where large cap tech might start to underperform the S&P 500? That would be an indication that the market's going to be ready to move into a correction. So watching the relative strength with the NASDAQ 100 and the NASDAQ composite against the S&P 500 is critical here going forward, because it's been outperforming for so long now. It's probably due for a little bit of underperformance, and that would probably coincide with the next correction. NASDAQ Composite, again, was saved by those earnings releases. Otherwise, it would have been negative for the week. Again, look at the relative strength here. It's starting to catch up against the S&P 500. If this slopes lower and the NASDAQ Composite starts underperforming the S&P 500, then the market will likely process its first correction of the year. The Dow, being less weighted in technology stocks, did outperform the S&P 500 this week. And then if you look at the small caps, again, they are now down 5 out of the last 6 weeks and bounced off the 10-week moving average this week on very heavy volume. There's a lot of regional bank stocks in the Russell 2000, which the regional banking sector was under major stress this week. Another thing we'll talk about in the sector review, but that's another potential major negative for this market, along with lack of participation. Now we've got potential banking problems, which is what caused the major move lower in March of 2023, where we had a mini banking panic. So that is going on here. If the Russell continues to break down heading into next week, that's a big warning sign for this market. Russell 2000 growth was up this week just slightly, but continues to underperform the S&P 500. And then looking at the breadth, again, this is a telltale sign of this market. The market is up in January and February so far, but breadth is declining the entire time, which means less stocks are participating. More stocks are catching back up with their 50-day moving average, and there's not a lot of trading opportunity because the market's extended and there's less stocks going up. And if you look at the NASDAQ makes new highs this week, but there's less than 50% of stocks now above the 50-day moving average in the NASDAQ. So again, much thinner market being led by mega caps, and these type of divergences tend to lead to corrections. Looking at the VIX, as we noted in the newsletter, the VIX is now up for about 7 weeks in a row and is now closed higher than the 10-week moving average. The VIX actually tried to break out this week, and the VIX tried to break out 2 weeks ago. And the earnings releases, again, both of these weeks really saved the market. SMCI saved the market 2 weeks ago, and Meta and Amazon saved the market this week. So again, we're kind of knocking on the door of a major breakout in volatility here, which would coincide with a correction in the stock market. Finally, looking at volume coming into UVXY, the major ETF that bets on increased volatility, you can see that volume is pouring into this ETF again. And this sometimes is a precursor to major pullbacks in the stock market. So this is interesting. If we do get a move higher in volatility, the institutions clearly are starting to hedge the market with this vehicle potentially. So overall, lots of things going on in the stock market. A lot of it is slanting negative. Even though the market's going higher, there's less participation. The NASDAQ now has less than 50% of stocks above the 50-day moving average. And there's potential financial turmoil in this market that's starting. So lots of warning signs. I think, the best course of action really is to stay patient. And if a correction does happen, then it's going to be a great buying opportunity over the next few weeks. But the key is really to stay patient and wait for that to happen.